What is up, ladies and gentlemen? In this episode, we are joined by Brett Schafer. Brett is a co-host of the Chit Chat Money podcast, a portfolio manager at Arch Capital, and writer for the Motley Fool. We discuss the biggest obstacles of growing a podcast, what it's like starting an investment fund, and strategies for identifying good businesses. We'd really appreciate a review on Apple Podcasts or Spotify if you enjoyed the episode. With that being said, let's get into it. All right, welcome to the show, Brett.
Hey, how's it going, guys? Good to be here. Glad to join Manifest Your Success. That's the name, right?
Yes.
On.
A big fan of Chit Chat Money. So getting right into it. So you obviously a co-host at Chit Chat Money, which one of the first podcasts I started listening to actually. So what was your aha moment, I guess, of discovering just how beneficial investing could be for you as an individual?
Yeah, well, just first off, thanks for listening, guys. Always appreciate the support. We always feel like our show is small, but there tends to be people out there listening, so glad to hear it. From an investing perspective, I was in a fortunate enough situation where one of my grandparents was able to give all his grandkids a little bit of inheritance money. And then my parents said, hey, if you're not going to spend this money, why don't you set up an investing account? And they kind of just let me do my own thing. And that was maybe 6 or something years ago, something like that. And I was in college. I had no idea what I was doing. I was just bought. I probably looked up some article online, like best stocks to buy, something like that. Had no idea what investing was. But then after that, I kind of got hooked a bit. You know how the classic stuff goes. You make a lot of mistakes in the first maybe year or so. You're like, oh wow, I was I was a total idiot. I had no idea what I was doing. But that's when I realized that you read like The Intelligent Investor, you read all those classic books that tell you how important compound interest is. And as someone that was, in kind of a math oriented field and engineering and stuff like that, I understood that the numbers really made sense and that, oh wow, you could actually save stuff now and delay it for 30, 40 years if you just put aside 10%, 20% of your money or even more. It can be extremely beneficial. And yeah, that's how I got here today.
Yeah, that resonates a lot with both of us, I think. I mean, a lot of people they underestimate investing and how powerful it can be. And it's not like a thing that reaps rewards. Like right now, it's more like, okay, I'm setting money aside now so I can be better off later in my life, or even 10 or 20 years, really. It doesn't have to be after you retire. I'm curious, like what, obviously you said your family got you started in investing, but like, what do you think made like the biggest influence on like you just like putting money in, like just to invest, and then like you really understanding like why you should invest in some companies and invest in other companies? Like what was the influence aside from some books, if you want to mention too?
Yeah, any influence? I guess I mean, I've always been fairly frugal, so I had some money just in my bank account, just saved up for many jobs I've been working, stuff like that, and I didn't have to take out any debt for college, or so I had some money saved up, so that kind of I was sitting, with earning whatever the lame interest is in a checking account. I said, all right, I better do something like that. So that was kind of the inspiration to get started. But then the influence on any style, I mean, you kind of go, I think everyone has this very similar journey. You look at, you search stuff online, you find the value investor stuff, or and you also at the same time kind of find the growth investor stuff. And those are the two camps that you really start out in. And the growth investor would probably be Motley Fool or Peter Lynch style, although obviously, investing is a spectrum and there's not just growth and value and it's tied at the hip and all that good stuff. And then the deep value stuff is, the Ben Graham, the Warren Buffett type, just classic literature that I guess everyone reads, or all the blog posts people read all the time when first getting started. So I was looking at both of those. You kind of see those when you maybe search something online just with the basic question like tips on investing or whatever. There's all those different YouTube channels or blog posts. Probably I was on the Motley Fool reading some of their free news reports, which is funny. That's where I work now, but I'd read a lot of those. So yeah, I was in both those camps. I mean, you kind of start out and you say, oh, this has a low PE, I better buy, or whatever, something like that. And you realize that maybe not, there's a bit more nuance than that, but that's where I definitely started to, I luckily, I guess I didn't get kind of too entrenched in either camp. I'm hoping to be very flexible as an investor as I grow, but yeah, starting out in the deep value, I think is where a lot of people start out, and that's where I was as well. I mean, you pick up The Intelligent Investor, everyone says, hey, you got to read this book. It's kind of the number one book, The Intelligent Investor. And when you pick it up, you're like, well, maybe this isn't the beginner book, because I don't know if I'd recommend that for a first timer. Maybe that should be like the 10th or the last investing book you read. But you read that and you okay, buy something for less than it's worth. All right, that makes sense. I'm going to buy something with a low PE. What does a low PE even mean? All that good stuff. And then you kind of move into, and I think it's very helpful to go both ways. You move into, say, I guess the Motley Fool style, where buy the best businesses, and I think that just makes sense for someone starting out. That's kind of good introductory lesson. But then if you're kind of trying to be more professional like myself, I guess you just kind of expand your knowledge and try to just move on from those stepping stones.
Yeah, I agree. I think it's a lot of like, you have to really like identify what you resonate with more, like your style. And the earlier you do that, I feel like the better you're off long term. Because like if you're jumping around like your first 5 years of investing or 10 years, then you're not going to have anything set in stone. And it's a long term game more than a short term game.
Exactly. You have like, at first you're not going to know the style that you like. And even if you're maybe a cynical person in real life, or you're maybe more, whatever your kind of psychological state is, it might not translate to exactly what you're comfortable with as an investor. So you have to, I think it's very important to test out kind of maybe different styles. Okay, am I more of a deep value person? And then on the other end of the spectrum, am I more of a GARPy person? Am I more of an active trader? Is that something that I want to do and maybe be more active with my positions? Or do I just want to be a buy and never sell person? There's a lot of ways to win in investing, and it really comes down to what you're most comfortable with. And I think that's kind of the journey you take, say, in the first 5-10 years of your investments, maybe not even career, but just say as you become an investor, either as a hobby or professionally, you will learn that, and it's going to require a lot of mistakes. We all have those, but you basically learn from that. And then once you know kind of what investing style you're good at, that's when, I don't know, you kind of, it kind of all fits together, if you know what I mean. The puzzle gets completed.
Right. I think a great way like for you to like not get caught up in so many mistakes is like having like a surrounding cast or like people that you can talk to. And like for me personally, like me and Sam are both interested in this. I mean, we've been roommates for the past few years too. Like we can bounce ideas off of each other. And I think it's so valuable because you hear a different perspective about a certain company and you're like, you start to rethink it. Do you have any, like, obviously your co-host, you have a co-host on Chit Chat Money, and like, what are some like friends or like mentors that you've had that really have influenced you? Or is it more just like a personal research thing that you've done?
Yeah. So Ryan is the other co-host on Chit Chat Money. Yeah, we went to the same college together and we know each other. We were friends. So that was someone who, we were talking about investing all the time. It became a hobby for us. And we realized that it was something we wanted to do more professionally. So definitely that, having a friend like that. But without being, I haven't really been in the industry per se. So I graduated with a non-finance degree. I haven't worked as like an analyst at a big firm or something like that. So the mentors have been more books I've read and then people I've met on financial Twitter. If you're someone listening to this and you're not able to, like, you're not in the industry, say you're not working at an investment analyst job, and you kind of want to learn, you want to meet more people that, I don't know, have the same hobbies as yours, you want to talk, springboard ideas, whatever it is, financial Twitter is definitely the place to be. I mean, you can see there are a lot of you got to have a thick skin on financial Twitter, but you can meet a ton of people, and that's really where I've met, I guess, a lot of people we've had on Chit Chat Money, a lot of people that we've met either through Zoom or in real life, and I think that's kind of the main things. I mean, just as an examples, gosh, I'm trying to think of some specific names. I mean, from books, it's Ben Buffett. Like, he's probably my number one. It's a cliche, but that's the number one role model. Listen to all the stuff they have, the old, old annual meetings, all the old letters, a lot of the stuff he's done. Yeah, obviously, he's really old now, but there's decades and decades of work there, and he's in my opinion. I don't think it's controversial to say the best, that's ever done it. And that's kind of as a role model from the, say, I don't know, the book side. But then from the financial Twitter side, there's just been a lot of professionals on there that say maybe have 10 years or 10 to 30 years of experience, have a lot more experience than me within the industry. And on Twitter, you can see what their thoughts are. They may be an anonymous account. They may be someone that's available to, put their stuff out publicly. But you see that on there. They always link to stuff they're writing because people are promoting their stuff. I mean, we do that with our own show. And you can find their Substacks. You can find podcast episodes they're on. That's kind of the main way I've had any mentors, if you want to say like that. I haven't had any specific mentor. Maybe some family friends that have pointed me along the right way at the beginning. But besides that, it's really been financial Twitter, which is, I don't know if it's the best way to learn. You kind of get your feet thrown into the fire, but over time, I think it can be really, really, really helpful.
Yeah. I think it's so valuable now. Like there's so many resources online, and if you use them to your benefit, then you can really take advantage of them and learn, do your own research.
Yeah, and especially like you mentioned financial Twitter. I spent a lot of time on there, and a lot of the guests we have on here are people that either like DM'd on Twitter or they've seen my tweets or for whatever reason followed me. And it's just easy to make connections that way and find people that you can learn more about through whatever resources they have through their own profile. But so you mentioned that you and Ryan went to the same college and you guys both got into investing. So when did you decide you wanted to start a podcast, and how did you go about doing that?
Yeah, that's I guess it's not an exciting story, but it is kind of interesting. We were both in college. We were both on the same sports team, and we were talking about it. We realized Ryan's a little younger than me, but he was getting into investing a little bit. I'd been interested in maybe slightly longer, but I was still, we were basically at the very beginning stages, and we were, podcasts were just coming up and say, what was it about I think it was the 2018 was the year. And then podcasts were really growing at that point. And we had found some stuff, the Motley Fool kind of was a big leader back then. But besides that, we were like, look, there's not that many. If I want to have a daily, not even a daily show, like if I want one show, maybe a day to listen to while either I'm working out or I'm driving or whatever, there wasn't that much out there. And from what it was, a lot of it, and I say this like with all respect to the Motley Fool, I work for them. Some of the stuff they were putting out was for a specific audience that maybe wasn't trying to really learn the nitty-gritty details about a company. And we figured, look, we're not finding that at all, so why don't we do it ourselves? We want shows about individual stocks. We want that. And we started out the first year or so. It was pretty bad. And you have to just learn as you go on. I mean, like looking back, some of the formats we tested out were really terrible, but some of them stuck. And then as we evolved, we kind of stuck with the formats that work great. And I don't know. I mean, it just continued to grow. We found these, I guess, well, one of the formats we do now is fairly new, but the two formats we've been doing for a while now, for the last, I think, 2 or 3 years, is one show is covering an individual stock on our own, basically researching that. We do basically about a week of research. And what we found is that works really well on an SEO basis, I guess. Well, not really SEO, but for people searching through a podcast platform, really helps for us to organically grow our audience without having to spend marketing dollars. So say we just did a show on, Sirius XM. People will look that up on Spotify or Apple. They'll look up that ticker, and then our show will pop up, and they'll say, okay, that's interesting, and then maybe they'll discover our show. And then the other one we do is an interview show where we bring on an analyst to cover, I don't know, the same thing, an individual stock, but from their perspective. So it's not us talking, we're asking questions of someone else. And we found that the same thing, searchability for someone looking for a specific show really, really helped. And that's what we wanted from a podcast. So we thought, okay, let's just build it ourselves. Obviously, like I said, when we started out, it was pretty bad and not everything worked, but now we're kind of a medium-sized show and we're still chugging along.
Yeah, that's a great. What you were saying kind of resonates with what we were talking about with investing, and you were like, okay, you got to try out all these formats for investing, and you did the same thing with the podcast, and you finally clicked and found like two formats that work, and you see the resemblance and the congruence between that. I'm curious, like, what do you think? Like, what do you think was the like, I don't know, the message, or like, what did you realize that you were doing right on these two formats compared to like other formats you were doing? Like if someone's starting a podcast, like what were some things that you saw and you were like, okay, this is definitely working. We should keep doing this. Like what were you seeing there through that?
Yeah, that's interesting. I guess we kind of looked at it as from an inverted perspective, where we're looking at what wasn't working or what we shouldn't do or what was just the same. So we didn't want to do like a news discussion, because those shows, say I think at the time there was like the Motley Fool one. I'll just use those as the example. There was like the Market Foolery and the Motley Fool Money. Those are financial news shows that were big. And if we copied their formats, no matter how much fun we made it, we're not stand-up comedians, so we're not going to be able to make it that much better. And they're already established. So we kind of copied what was already out there and already popular. And we didn't want that. And we knew that that probably wasn't going to be successful. So we knew that the ones that, like, there wasn't really anything at the time covering say, and I know now there's other shows like Business Breakdowns that are from the Patrick O'Shaughnessy. I forget what the name of their podcast network is, but that one, is very successful as well. It's called like Business Breakdowns. That's fairly similar to what we do, although ours are more stock oriented. There was nothing like that at the time. And we're like, okay, let's start these out. I mean, it takes a lot of work to do, but people seem to like it. And we tested out other things in the past. And basically, if we got good traction and we knew that people said, okay, hey, we like listening to this, all right, there's something there, then we'll just keep doing it until it stops working. And there's no other secret sauce besides that. We basically tested a lot of stuff, weren't afraid to throw stuff out there. And then, yeah, that's where we are. I mean, we obviously got probably a little bit lucky on the timing wise during 2020, because a lot of people got into investing then. Like you guys said, you discovered our show during 2020, and a ton of people, as we all know by now, discovered investing in 2020. And I think that helped a lot. But yeah, although we did take a break in the summer of 2020 for 3 months. So maybe we're unlucky in that regard. But again, in the fall of 2020, we saw a huge growth. I think that might have been just a general market tailwind.
Yeah, I think that's really important what you said, how you didn't want to like tackle that one path because there were already popular shows that did it. Because it's really important that if you're gonna start something like on your own, that it's something that you either can do better than what's already out there or like has a unique twist on it. And I think it was like Michael Saylor, someone who said that in a podcast, is like, don't start something unless you can make it unique. So I guess another leading to the next question, how do you think, like as a society, we can better spread like financial knowledge, given that obviously you don't learn that kind of thing in school, and like you said, you didn't start coming across that area, I guess, until college, because we just aren't taught that at an early age.
Yeah, it's a huge question, and I think people have been talking about that for decades, because whatever, I don't have any data in front of me, but whatever the data is, we all know that most people are, one, way worse with their finances than they should be, and two, invest I guess more poorly than they should be, or they make, a lot of poor decisions basically. And I'm not even saying like buying this stock versus something else. They just will buy whatever it is, some poorly performing like high fee mutual fund, something like that. And or their whatever their savings rate is not just optimal, however it is. I don't know how to solve that, because it seems like there's just the human psychology is just really hard to overcome. And we have the instinct to think about stuff in the immediate term, or a bias to think about stuff in the immediate term. And it's really hard for people to focus on, in general, I mean, for all of us, to focus on things that are 10, 20, 30 years out, or have, delayed gratification, however you want to describe it. So I think that's a really difficult hurdle to come over. But I guess the big tip I would have is just to simplify stuff, because however you're teaching it, there are a lot of terms that people get overwhelmed with. And no matter how smart you are, when you get into, say, the investing or financial world, whether it's just as either a hobby or professionally, or you're trying to learn some stuff to manage your personal finances, it can feel intimidating because there are a ton of words to learn. There are a ton of terms, definitions. I think just simplifying it is better, because in reality, you don't need to learn that much. The actual blunt information, if you're trying to just save for retirement, you're not trying to become someone that learns how to analyze an income statement or cash flow statement and SEC filings. Honestly, doesn't take that much work, but there are just maybe 10 or so things that are super basic that people can understand. Say like that could be extremely helpful. And I think we really kind of start running in quicksand or can't make any, forward progress when we have all these entrenched, like not entrenched. We have all these super difficult things that people like. It seems like an insurmountable hurdle to learn about personal finance. And in reality, it's not that difficult. And that's probably keeping a lot of people away. I think second is just giving people good tips about defeating that site, like those instincts that we have that maybe will lead to poor financial decisions. For example, I think the best one, and this is maybe the easiest one to do, instead of saving after you, like, okay, when you save or you put money away every month or every 2 weeks when you get your paycheck, I really think you have to put the money away first. Like if you're going to save 10%, you have to put that money away first, or else you're going to spend it all. Because if you say, all right, I'm going to save whatever I have at the end of the month, you're not going to have anything at the end of the month. And if you're in a comfortable financial situation and you can say, look, I got my paycheck, I immediately put 10% or 20% of that in my Roth IRA or whatever savings vehicle it is. If you're saving for a house or something like that, you immediately put it there. And whatever you're investing in, as long as it's not, Dogecoin or something, it's not going to be, you're not going to destroy your finances. But if you don't set up that kind of habit with yourself, when that month's over, you're not going to have anything left over and you're never going to get that compound interest started. So I think that those two things, simplifying it and then setting up habits. Now, getting society to do that, I have no idea how. And if I could snap my finger and get everyone to do that, I would. But it seems like a big hurdle for everyone to educationally too.
Yeah, that's a great
cross.
point. That's a great point. I think, I mean, like, just like you were saying, like, so simple. And like one simple thing that anyone can do is like open up a Roth IRA, like before they're 30. And like, if you just start doing that at 20 and do it for 10 years, even, and like, that's just a simple task that everyone can do and it'll benefit them long-term in life. But it seems like that, like, I don't know, society doesn't want people to do that. I have a theory. This is kind of just work with me here. I have a theory that like the reason, I mean, we just recently did an episode that like is titled College is a Trap. And we talked about like how it, like they can kind of take advantage of your money and whatnot. And so society, obviously there's people that are implementing these laws like in education and in government and finance and whatnot. And if they're creating these laws and they don't want people to be financially free with their money, because then there's less people that are relying on the government. And the more people that are relying on the government, then the more power that the government has. And I don't know if you want to share your thoughts on that, but that's just a theory that I have. It's like the government doesn't want like, yeah, they could invest this money in like education, like for high school and like public education, but that's just going to lose their power as a government. What do you have any thoughts on that?
Yeah, it's plausible, but I haven't thought about that angle, I guess, very much. I think, yeah, it could make sense. I think in general with the college stuff as well, there's just entrenched incentives to get people to come to the school. We have all the administrators, we got all these expenses, we got to make up for, we got to legitimize it somehow. And, the expenses basically on the school side and then on the tuition side can get super bloated, as we all know. And it seems like something that cycle is super hard to break when you have, and basically, and when you add on the government thing there, like you said, I mean, the cycle is super hard to break. And you do kind of realize that a lot of the expenses when you're at the school, like I guess you guys are in right now, and I was a couple of years ago, you realize that a lot of the expenses are wasted. Like, and you're like, wow, this could be a way leaner operation um than it is. And yeah, well, that's another $1 billion question that I don't have a good answer to, but it's fun to talk about.
Yeah, for sure.
Yeah. So you mentioned that like you and Ryan started the podcast back in 2018. So that was 4 years ago. When like along that timeline did you guys decide that you wanted to start Arch Capital, and like what was your motivation behind doing that? And I guess if you had any background experience in portfolio management, did that play a role in it?
Yeah, so I guess to answer the last question, we didn't have any experience, and this is the plan is for this to be our experience as sort of, as we get started here. So I guess I should explain what it is. Arch Capital is just investment fund where we have a few limited partners, basically as family and friends right now with small amounts of money. And it's just a standard, I mean, it's a hedge fund structure, but we're just an investment fund. We're not, long, short or anything like that. It's just very standard stuff. And I can get into more, we maybe talk about more details about our investment philosophy if we have time, but the inspiration to start that out was we wanted to manage money, and we knew we wanted to eventually, like at some time when, maybe we're older, but there's kind of a chicken and an egg problem where you have to establish your track record, and you can't establish a track record unless you've been managing money, and people don't want to give you any money unless you've established a track record. So we figured, okay, look, we're young, we're still inexperienced, we're still growing, we're still trying to learn how to do this thing, but why don't we just start out now? And we might, not be able to attract much money. We haven't. We kind of knew that we don't have any sort of, I don't know, like say a 10 years at an investment bank to get some money from whoever. I mean, we're not going to be able to attract any big dollars right now, but 3-5 years down the line, if we do well, then things can be very, we can have that track record. If you guys kind of get what I mean. So it's, yeah, that was the motivation there. We eventually wanted to run outside money. We think that there's a lot of improvements to be made on both on the fee structure that people charge and on funds. Like, okay, so like we just think there's a huge opportunity where the fees that people charge on a lot of investment vehicles for either large institutions or individual wealthy people that would qualify for these type of things are way too egregious. 2-3% a year, huge performance fees, and we thought we could offer something that's better than that. So we have a zero flat fee, plus we only earn a performance fee if we outperform the S&P 500 on an annual basis. And then second, a lot of these funds are just tracking the index. So we think there's just a big opportunity to continue to ride that wave of not ride the wave, really would be the wrong way to describe it, but to offer something that isn't just a closet index with higher fees. So our strategy is to just own 8 to 12 companies, probably around 10 or so. It might change, it might be a little higher, it might be a little lower, with heavy concentration, and hold them for the long term. We just think that product is something people are looking for and is how we invest. So I guess that's why we do it. There's a lot of different ways we do it. We're still building Arch Capital. It's very early in the process. We have essentially no money under management, but to sum it up, the whole goal is to really establish a track record that's audited. I mean, we can have our personal accounts, but investors don't care about that when trying to when they're going to give you some of their savings.
Right. Yeah. It seems like you're just like kind of doing it just because like you need to get started, and you see the value in like starting something and just see where it takes you. So if there's like a listener like and they're hesitant to start something, whether it be an investment capital fund or something else in their life, what would you say like the value is in just like starting, and like why is it so important just to get started for doing something that you want to do?
Yeah, that is a great point. I think we've learned to just be courageous with starting something and not being afraid of being. I mean, there's clearly people that if they saw that, I mean, not everyone, is following what we're doing, but say someone sees that we have a small investment fund and we're starting it out, we're under 30 years old, we don't have too much experience. That might be like, oh, look at these guys, they're way overconfident or something like that. Or, they might be, people can be critical and stuff like that. We all have our faults with doing that. I'd say you just gotta ignore the noise and try. There's no point in not trying because, or I guess you also don't want to really be afraid of failure because we kind of looked at it as, okay, there's two different paths we can go down. We can start the fund or not start the fund. And then if we start the fund, at one point, it'll either be a success and it'll become a sustainable business, or at one point it'll fail and basically we'll go back to zero. All the money that we put in, I mean, we'll be at net zero. There'll be no income generated for us. We won't have a business built. But if we don't have the business built and kind of the fund fails, say we don't, it really doesn't, we don't attract any clients, say within the next 5 years or something like that, we're basically at the same starting point as if we never started again or never tried it out. So I think it's almost always better if you have an idea to try something out. I mean, most things fail, but it's weird that a lot, and it kind of comes back to that psychological stuff we were talking about. There's just a lot. If something has uncertainty, if uncertainty is rising with a situation, and maybe if you start a company, there's only say 30% chance it'll be a success. And I'm not talking about a startup. I'm talking about, a small business like the one we're trying to run. That can be scary, and a lot of people become afraid of that and would rather go to a salary job where you have almost 100% chance of success. You have to just weigh, I think, the risk reward in the situation. And yeah, if you start out something, there might be a 30% chance of failure or whatever, or 30% chance of success or whatever the number is. But the upside of being able to run your own business, the freedom of that, the financial freedom of whatever it is when you get wealthy, when you run your own business, just so much higher than that chance of failure, or so much better. That upside is just so much better than that chance of failure that I think if you want to try it, you should. And if you fail, that's fine. I mean, you just got to look, like, it'll feel bad, but I think it feels worse to not try it at all. And it does get scary to try to start something on your own. It can be intimidating. I'm sure you guys have felt the same way when you're starting a podcast. You feel nervous, like, I don't know what I'm doing or whatever, but everyone feels like that. And then another thing we've learned, and I think you guys have probably learned as well, everyone kind of learns that, is a lot of people have imposter syndrome because no one is just perfectly, okay, I'm doing this, I have all this sort of expertise in this situation, even though it seems like that from an outsider's perspective. Maybe you see like a investing professional that you think is like perfect. There's or they have a great track record. They've raised a ton of money. There's someone like that. You have that goal of getting to somewhere where they are in their business career someday. They're probably, they just made it up as they went along, if you know what I mean. And if you feel like strange or a lot maybe confused or afraid because you feel like you're just making stuff up as you go along, a lot of people did. I mean, even if you look at Warren Buffett, he basically just tried to set up a situation throughout his whole life where he could invest how he wanted in whatever vehicle it was. He just came along Berkshire Hathaway, and that was just a fluke. And he just basically made it up as he went along. And now people think like, okay, in a hindsight bias, we're going to look back and say, oh, it was destiny that Buffett was going to get to where he was. No, there was a ton of different scenarios that could have gone down, and he just made it up as he went along and made the best decisions he could. There was tons of uncertainty along the way, and that's what it's going to be like for you. And I don't think that should stop you from starting something out.
Yeah, so I guess sort of like a fake it till you make it mindset.
Yeah, that maybe I think that was what I was trying to come up with. That is way more prevalent than people think. And you shouldn't deceive anyone, but a lot of people are going to feel like they're faking it till they make it, even though they're actually just doing what everyone else is doing. A lot of people are going to feel like they're faking it. I mean, we basically felt like we were faking it under the podcast for a long time, and we didn't really even realize our show was doing fairly well until I don't know, it's kind of hard to there's no like barrier where it's like, oh, you hit this amount of listens or whatever, and now you're a professional show. I mean, we're doing it the same we did 2 years ago. Obviously, we've gotten a little better at doing it, but it's strange how that works, especially in the internet age.
Yeah. So you mentioned that the deep dives on Chit Chat Money was one of the segments that you did that really took off, and you've been doing that for years now. So I guess seeing as you've identified a lot of businesses and combed through them, you said you would spend a week researching them, and you kind of seen like what tends to work and what doesn't. What would you say to like someone who has like super basic investment knowledge? What would you say are like the best ways to identify a good business?
Ooh, well, I'll try to keep it as short as possible because there's a lot of you can get complicated here, but I think a good business is one that one turns their earnings consistently into cash flow. Two is in a durable industry, which means that demand is forecastable. So, what's an example of an industry with good forecastable demand? I guess an easy one that everyone will know. Maybe. Yeah, I think that would probably, yeah, that makes sense. Yeah, for durable. Now, on the last one, I maybe with cybersecurity or some of the other points, some people, or most people that are listening will not. Maybe cybersecurity won't qualify for what I'd say is a good business, but that's a different topic. But yeah, durability, say candy, I guess for anyone that probably will know. Like, will there be demand for Reese's peanut butter cups? Is that forecastable? I think yes. So I think that that makes a good business. And then third, and this is a cliche, and everyone already knows this, but they have a competitive advantage. There's, I think, a few ways to look at that, and you can do a whole podcast and multiple, tons of writing out there about what a competitive advantage is. But basically, they have from their business model, their scale, their relationship with their customers, or their intellectual property, among other things. They are insulated from any upstarts, competitors. They're able to price things better. They are able to retain their customers. I think that is a quality that you need for a good business. So, yeah, I think those three things would be the key. I can't remember. I might be forgetting something, but yeah, converting your earnings into cash flow, durable customer demand, whatever that is. That could be a business to business or consumer facing, whatever it is. Durable customer demand and then a competitive advantage. I think those three things. And that's not even really getting into the numbers, which I think the numbers are the numbers. Like, you can run as many numbers as you want. You can put as many numbers in a spreadsheet as you want, but that, in our view, I guess, is pretty much in this. I think a lot of people's views is that it's a commodity now, unless you're a huge fund that has a quantitative advantage, like say, what's it called? Renaissance. I forget what it is called, but the one that Jim Simons runs, those quantitative funds, you're just on the numbers alone, you're not going to be able to win over the long term. And I guess the definition of winning might be different for everyone, but if you can answer those qualitative questions, that's not something that can be kind of arbitraged away by a quantitative fund or some big investment bank or whoever. All the other people looking at the market. I mean, if you look at something and it has a low PE or it's trading at a high free cash flow yield, everyone knows that. So you have to answer, okay, is there durable demand here? Is there a competitive advantage that I can identify? And are they turning their earnings into cash flow? Because I think that last one's very important, because if they can't turn their earnings into cash flow, they're not going to be able to return capital to you as the shareholder, either through dividends, buybacks. And that's how you make your returns in the long run if you're going to invest on a 10 to 20 year time horizon. I think that's just vital. But yeah. There's a lot of other stuff we can go into there, but I know that's not what the
Right.
show is all about.
Yeah. Statistics. There's this book. It's like statistics can lie or something like that. And it's like you like any stat out there. It could be an accurate number, but it might not actually like translate into it being a good company. And like everyone can bend numbers and bend specific statistics to try to influence a company to look better than it actually is. I'm curious. You mentioned competitive advantage, and I want to put you on the spot here. So feel free to take some time. Like, what do you think is a good example of a company that has like a good like competitive advantage or economic moat, and like whether it be a company that was Coca-Cola all the way back, or an old company, or something that you see that's going to be that's underlooked right now. What's like one company that you haven't identified their competitive advantage? You think?
Okay, yeah, let me try to think of one that people can relate to, because I know if it's like a business to business software company, most listeners, it's harder to grasp from a start. I mean, let's look at Electronic Arts, or EA, which we owned in the fund, so I just full disclosure there, but I know about that one better, so I can talk about it maybe briefly. I think there are a few competitive advantages with them. So when you look at a video game publisher, at its core, they have people that work for the company. They build the game, and then they publish the game, and it gets distributed on all the platforms. But on Electronic Arts specifically, there are two key competitive advantages that we think keeps them insulated from the competition. One, they have the exclusive licensing rights for a lot of the sports games. And within FIFA, it's even deeper, because you have to get the dozens and dozens of leagues across the world to get those exclusive licensing. So when you have those, it's really hard to compete, because other companies are able to make soccer simulation games, which is just say something that looks like FIFA, but you don't have all the players, you don't have all the leagues, you have to make these fake leagues. And we've seen ever since FIFA has gotten these exclusive rights, and I know we don't need to go into how they're going to lose the name, but keep all the leagues next year. But when they have that gives them a competitive advantage. And another one which makes EA's sports games even more insulated from any upstart competitors is that the social aspect, where when you're playing, especially online, you need to be playing against someone else. So these games that have the most players playing them will have the best online experience, and you're able to play the most, whatever you can match up with someone that's your skill level. You climb the rankings versus all these other players. And there's just a clear network effect there, where given the social aspect of these games, even if someone can put out equivalent game, and for some reason people played them even though they don't have Messi and Ronaldo, you're not gonna like if there's 20 million people playing FIFA around the world, and this other game only has 500,000 people, or maybe even less, say 100,000 people online at the end of the day on a Friday, the experience is going to be much, much better on FIFA. And it's just extremely difficult for someone to overcome that and getting those licenses. So I think that's what a competitive advantage is. And that makes their earnings more forecastable in my mind. And then there's other stuff with their other, EA is not just EA Sports. They have their other IP with gaming. But yeah, I think that hopefully that makes sense. I know sometimes describing competitive advantages can be strange. And if you don't, sometimes like when we're looking at something, we can understand a competitive advantage for this one company, and we might look at a company that a lot of other people own or have owned for a long time. A ton of smart investors that we respect own it, and we just don't get it. So I think that's another thing. If you're an investor, if you don't understand something, there are tons of fish in the sea. I mean, what are there? I think there's tens of thousands. There's at least 10,000 companies around the world that you can invest in now. And if one company doesn't make sense to you, I mean, you can pass. You can pass as many times as you want. Again, it's the classic Buffett analogy. You could think of it as like a hitter in baseball, and you have an infinite amount of strikes you can take. So you can be incredibly patient, and you want to find a company, if you're going to be an investor within the strategy, a fundamental investor with a long-term time horizon, and you kind of want to be a buy and hold person. I mean, I think it's really important to look for something that has a competitive advantage. And you'll be able to find that if you have any, if you have some sort of competence, you don't need to be a math genius to do this, but you're not, it'll, I don't know, it'll kind of, you'll know when you see it, I guess, is the way I'd maybe describe it. And if so, a lot of other people are looking at a company and say, look, this is a genius company. They look at what they're doing. You might be like, all right, that doesn't make any sense to me. That's fine. You just got to realize you don't need to hop on that bandwagon of everyone else investing. You got to wait until that fat pitch shows up and it makes sense for you to swing.
Yeah, that makes sense, because I know if like I play FIFA, or at least I used to, and I know if like it didn't have, if there was an alternative game that didn't have the actual players that play in real life, I definitely would not be playing that. But so real quick, I know you write at the Motley Fool now, and like my dad's always telling me, and I see all the time, people are saying like writing is such a valuable skill, and like if you can learn to formulate your thoughts like on a piece of paper or wherever you're writing, like effectively, then like it's so powerful. So I guess like how long you been writing for the Motley Fool, and is there anything like that you've gained out of it so far?
Yeah, so I've been running for almost 2 years. Basically when I came out of college, just as to be fully transparent, the podcast and the fund do not make. We have 3 people. One person is more behind the scenes, but it does not make enough money for us to live off of it. All 3 of us. So I write for the Motley Fool basically as, to get income to pay for rent and stuff like that, and it's a great job. But I think it can serve as a way to. It's kind of weird. Sometimes you write something and you're like, okay, I actually thought about. I thought about something, if that makes sense. Like, you thought you had this idea in your head, but when you write it down in an article and try to maybe, I don't know, the Motley Fool articles are a little shorter, so they're like less than 1,000 words, but you try to sum it up about this pitch on a company, or why this company is special, or why this one news announcement is interesting. And when you write it down, an idea might click in your head, or you might think, oh, well, wait, that doesn't actually make sense to me. And you don't have to do this publicly. So I think when you have an investment idea, writing it down can be extremely helpful, even if it's just in a journal. I mean, what we do for the fund is we just have a Google Doc, and whatever it is, we write down what our idea is at the time. We log it, we date it. And yeah, it's important to write down what it was, but I think what's even more important is if you come back to something a year later, your mind will have a tough time remembering exactly why you invested in something, and it might try to trick you into thinking, oh no, like I didn't think that was going to happen, or if this happens, it's fine. Like, say a negative scenario came up and you're like, oh no, it's fine. Like, but if you actually go back and look with a date, what you wrote down beforehand, you say, oh no, we're looking for these risks, blank, blank, blank. One of those risks materialized. Okay, maybe the company wasn't as good as we thought. Having that journal, having that stuff written down can be a way to catch yourself from trying to trick your, kind of convince yourself, oh no, the company's fine or whatever, or it's better, this bad thing may have happened, but I don't know, like when you're an investor, you kind of, it's tough. Like the old investor, it's hard to remember exactly what you're thinking as, say, someone what you were doing a year ago. I mean, try to remember exactly, it's extremely hard. Hopefully that makes sense. I don't know if I think I had a hard. Okay.
Yeah, I'm someone who journals myself, and even outside of investing, you gain so much value, like writing down an idea, and like you might come back to it like a year ago or a year after, and you like look at the idea and be like, why did I write this idea? Like, this is stupid. Or you might be like, okay, this idea actually makes sense, and I should maybe take an action on this idea itself.
Exactly. 90% of the stuff that you write down will probably be a waste. And when we write notes down, or when we write our pitches down internally, or if we're just journaling by ourselves, 90% of it we'll probably never look at again. But the 10% that we come back to will probably be very helpful for understanding the context of what, say, future decision we're trying to make.
Right. And that brings me to a kind of off topic, maybe not. You had a quote in your Twitter bio. It's quoted, "I don't want to be remembered, I want to be forgotten." So I saw the quote and I was like, oh, this is interesting. Like, so can you explain that quote and like why does it resonate with you so much?
Yeah, so that is it's sort of a joke. because it was from Seinfeld and it's something that George Costanza said. So I thought it was always a funny line, but it kind of resonated with me because a lot of people, I think, make an error of trying to do something, especially in investing, where they either one are trying to feel, I think the right term would be superior, where they don't actually care about making money. They just want to feel like they have superior knowledge about a topic. I'm sure you guys have felt the same way as maybe a younger person, like, those old, there might be some old, very cynical, not maybe old is even the wrong term. There might be some more experienced, cynical people on Twitter or whoever around the internet or that you talk to that really try to feel superior with their, I don't know, whatever their knowledge is. And then second, a lot of people just want to be famous in the investment world. I mean, yeah, even my biggest role model, Buffett, in investing, maybe kind of caught that bug a bit, where he doesn't stray away from the limelight, or at least he didn't in the early 2000s and 2010s. But yeah, I mean, it kind of just, like it says, I don't want to be remembered, I want to be forgotten. Like you're doing it for yourself, and that's kind of like, that's how I want to. I'm not doing this to, I don't know, prove to anyone anything. I'm not doing anything in investing or at Chit Chat Money or at the fund to, I don't know, make some sort of, like, to make myself look better to other people. If you get what I mean, I'm just doing it because that's what I enjoy. And I think that quote makes sense. And it's also funny. I forget the exact situation, what episode it was from, but it was
great.
yeah, there's actually a ton of analogies you can make, because I mean those, Seinfeld was so popular because the real life situations were so relatable. There's a ton of analogies we've used to formulate investing thesis from Seinfeld. It can help people. I think it can be helpful to use those type of scenarios that people may have watched in a show or something like that to kind of bridge the gap. Oh, understanding what an investment thesis means. Obviously, we're not investing in something because we just saw it on the show, something clicked in our head. We're doing more work than that, but yeah, it can help for writing something.
Yeah, that definitely makes sense. But we're coming up on an hour here, so we want to be respectful for our viewers, and we normally end with one final question. So, what is one goal you have in your personal life or your career, and what steps are you taking to achieve it?
Yeah, I'm gonna go with the basic one, and it's just to be free to do whatever I want. So that doesn't mean being insanely wealthy. It just means having the stability of earning, and from stuff that basically not even earning. I guess there's two qualifications there. Having the stability of earnings and having those earnings coming from something I'm doing as opposed to being a salaried worker somewhere else. So those are the goals I have, and that's what we're trying to build at Chit Chat Money and the fund, which are, they're kind of connected at the hip a bit as we try to be very public with our portfolio management and the investment fund we're running. So I'm just working every day to make the show better and trying to become a better investor. And I think over time, it might take 10 years, it might take 15 years. I'll be able to achieve that financial freedom. I don't really have a huge budgetary needs or wants in my life. So whenever I hit that kind of hurdle of income coming in, that's kind of the goal. That's kind of goal I have. And yeah, hopefully, I mean, it just takes making the show better, getting better as an investor, and eventually putting up, good returns for clients, and kind of the results will take care of themselves.
Yeah, that's a great point. Me and Sam, I think, both see the value in like financial independence, and the rest of your life will just benefit hugely off of it if you can really achieve that. Whatever your target financial independence level is. I'm curious. Obviously, we're gonna attach your Twitter, Chit Chat Money links and whatnot, in our bio. But is there, or show notes? Is there anything else that you want to leave for the listeners? Maybe books or websites that you want to link?
Yeah. So search Chit Chat Money on any whatever podcast player you're on. It'll show up. It's got a green logo. You'll be able to find it there. And you can follow us on Twitter. It's at Chit Chat Money. If you search Chit Chat Money on, I guess the Twitter search function is pretty poor, but if you search on Google, you'll be able to find it pretty easily. Besides that, no, I mean that'll have links to our personal accounts if you want to follow those, but that has more just personal investing thoughts. No, I think those are the two best ways. We don't have presence on many other social media platform. So it's just Twitter. So yeah, I think that sums it up.
Awesome. Well, we really appreciate your time.
Thank you.
Thank you so much for coming on.
Glad
Yeah,
to have you.
glad to be here. It was a fun time chatting.